Warren Buffett spent 2 decades calling Google the one that got away. In fact, his insurance company, Geico, handed Google millions in advertising dollars over the years, and Buffett watched those ad campaigns print money through his own portfolio. But he still refused to buy. Then, at 95 years old, sitting on the largest corporate cash pile in history, he backed up the truck and bet on Alphabet. And Wall Street thought the new CEO, Greg Abel, had dragged Berkshire into tech. But then, Buffett looked the media cameras dead in the eye and said the decision was his. The man who supposedly never overpays just paid up big for Alphabet while its stock was sitting near all-time highs. So today, we break down why the greatest value investor alive finally decided to change his mind. Why Wall Street's story about who really made this trade is dead wrong, and why Alphabet's latest earnings report has some people believing Buffett just bought the top. My name is Nick, and this is the Finance Bureau. Okay, considering that we're talking about Buffett over here, we need to kick things off by getting a clearer picture on the scale of the money involved. As of March 2026, Berkshire Hathaway was sitting on roughly $397 billion in cash and short-term investments. Nearly $400 billion, a record climbing quarter after quarter after quarter. Berkshire had been a net seller of stocks for 14 straight quarters. They dumped $8.1 billion of equities in the first quarter of 2026 alone, exited more than 15 positions, and Abel's first buyback in 21 months came to a measly $234 million. It would appear that Buffett and his team looked at almost the entire market and found nothing worth owning. This was a man hoarding cash and refusing to touch anything at these prices. And then he wrote a $31 billion check for Alphabet. So, why this stock and why now? Well, for years, Buffett has openly admitted that passing on Google was one of the worst mistakes of his career. And a big reason that it stings so badly for Buffett is that he was perfectly familiar with just how effective Google was as a company. Geico, which is a company Berkshire owns outright, was one of Google's biggest advertisers for the better part of 2 decades. And Buffett watched from inside his own business as Geico paid Google a hefty sum every single time somebody clicked on an ad. He could see the economics with his own 2 eyes, and he understood Google's dominant market position better than almost anyone on the planet. But he sat there, in his own words, sucking his thumb, doing nothing. The greatest capital allocator in history was staring at the single best business model of his lifetime, and he passed. Some analysts have actually run the numbers on what his hesitation has cost him. Had Buffett deployed Berkshire's excess cash into Alphabet, Amazon, and Microsoft a decade earlier, they estimate it could have added hundreds of billions of dollars to Berkshire's market value today. That's a hefty price tag for 20 years of sucking thumbs. And in July 2026 interview with CNBC's Becky Quick, Buffett didn't downplay it. He calmly said that he made a mistake by not investing in Alphabet sooner. At least right up to the moment he finally did pull the trigger. And as I alluded to earlier, the timing around that trigger created a narrative that Buffett had to personally shoot down. And that story begins with Greg Abel, who officially took over as Berkshire's CEO on the 1st of January 2026. And the big Alphabet buy happened right after that. Berkshire first disclosed an initial acquisition in the third quarter of 2025, which is around 17.85 million shares worth roughly $4.3 billion. Then, in the first quarter of 2026, that position more than tripled to over 50 million shares. And in June, Berkshire went even further, committing $10 billion to a private placement as part of Alphabet's $80 billion equity raise to fund its AI build-out. So the narrative actually perfectly writes itself. You've got a new CEO who takes over, and the historically tech-averse Berkshire suddenly piles into an AI giant. The media painted a picture of Greg Abel flexing his muscles, finally dragging the old dinosaur into the modern era. But as it turns out, that was totally wrong. When Becky Quick asked Buffett directly whether Abel drove the trade, Buffett's answer was clear as day. I initiated it. He actually went further, saying normally he wouldn't answer a question like that, but he would, because he isn't doing anything that Abel doesn't approve of, and Abel isn't doing anything that he doesn't approve of. They talk all the time. But this specific call, the Alphabet call, that was Buffett's. Abel technically holds final authority as CEO, but on this particular trade, Buffett explicitly took the lead. But at the same time, that's what makes it so surprising, because this is Warren Buffett, the master of buying low, choosing to pay full price for a stock trading near its all-time high. So then, what did Buffett actually see that finally made him pay up? Well, a simple way to answer that is by looking at Alphabet's recent earnings report. In the second quarter of 2026, Alphabet reported revenue of just under $120 billion, up 24% year over year. That's an acceleration that shouldn't even be possible for a $4 trillion of market value. But then there was Google Cloud. Cloud revenue hit $24.8 billion, growing 82% year over year. Now, just to put the scale of this into perspective for you guys, in the most recently reported quarter, Microsoft's Azure grew around 40% and Amazon's AWS grew around 28%. Google Cloud is now growing at double the rate of its two much larger rivals. And more importantly, it's generating serious profit. Cloud operating income grew substantially year over year, with operating margins expanding significantly. The backlog, which is basically the pile of contracts already signed but not yet counted as revenue, sits at a colossal $514 billion. Core search also grew by 17% and remains the money printer funding everything else. This is the durable, compounding cash operation that Buffett has hunted his entire life. A dominant market position and pricing power paying off. This is exactly the quality that justifies a premium price tag. However, not everything was perfect when it comes to Alphabet's earnings reports. But before we get into that, if you like these kinds of deep dives that give you insight into why the market is moving and where it's going next, then you need to sign up to the Finance Bureau newsletter. It's completely free and it lands in your inbox once a week. We break down the biggest moves in markets, macro, and monetary policy into clear, digestible insights so you never miss what actually matters for your portfolio. Just click the link in the description or scan this QR code on the left of your screen to get started. Now, back to Buffett. Because if the story ended with those glorious earnings numbers, this would be simple. But life and markets are never that simple. There are two problems with Buffett's trade, and the first is the price. Buffett bought near the top. His entire doctrine is built on discipline about entry price, and yet he paid up for a stock that had already run enormously. Remember, Alphabet won a landmark antitrust ruling back in September 2025, and the shares were up around 74% since that decision. But the second problem is one that really raised some eyebrows. Buffett bought a company that is currently bleeding cash. For what appears to be the first time ever, Alphabet's free cash flow turned negative. The company that has printed spare billions for years couldn't cover its own spending. And the reason for that is, you guessed it, the AI arms race. Alphabet's capital expenditure for the quarter hit almost $45 billion. And management raised full-year guidance to a whopping $195 to $205 billion. Just to put that number into a little bit of context, full-year capex in 2025 was around $91 billion, so they're roughly doubling it in under a year. And the CFO, Anat Ashkenazi, told investors that 2027 spending will increase significantly on top of that, with no ceiling given. Needless to say, the market's reaction told us everything we need to know. Despite crushing on revenue and cloud growth, the stock fell in after-hours trading, dropping around 3%. In a funny way, the market punished Alphabet for the exact spending Buffett is betting on. Alphabet reported net income of $112 billion, up nearly 300% from the year before. and diluted earnings per share of $9.11 against expectations of around $2.90. That sounds like a monster beat, right? Well, no, because that number was inflated by roughly $99 billion in unrealized gains on Alphabet stakes in Anthropic and SpaceX. Strip out that paper profit, and core operating earnings came in at around $2.90 a share. In other words, right in line. So you can easily argue that Buffett paid a premium for a company burning cash with an open-ended spending commitment whose headline beat was largely a paper gain. But let's be real, guys, Buffett is no dummy. He would have anticipated Alphabet's aggressive AI spending. So how does he reconcile this odd mixture? How does the most disciplined investor alive justify what seems like a relatively speculative bet? Well, this is where we need to dig in beyond the headlines and consider what Buffett is actually reading when he looks at those capex numbers. The market sees $200 billion of spending and a negative free cash flow, and that looks like weakness. But Buffett sees Alphabet winning this AI race. Because remember what he said about why he finally got interested? He became attracted to Google and its rivals once they started, in his words, spending like railroads and utilities. Buffett has owned capital-intensive, infrastructure-heavy businesses for decades. He owns Burlington Northern, an actual railroad. He owns utilities that swallow billions in capital and spit out reliable returns for generations. That capital intensity is not something that Buffett necessarily considers an issue. On the contrary, it can actually be the thing that stops the next competitor from waltzing in, because let's be real, who can casually write a $200 billion check for AI infrastructure? When Alphabet was an asset-light software company, Buffett couldn't get comfortable because he couldn't be sure a challenger wouldn't eclipse it within 5 years. Now that the game requires hundreds of billions of dollars in physical data centers and custom chips, the field of competitors shrinks to a tiny handful of giants who can afford to play. And that 82% cloud growth, that surge in operating income, that $500 billion backlog, that is the return on the spending already coming in. Buffett is largely considering this capex as investment that's starting to convert into revenue. Now, this isn't exactly vintage Buffett. I mean, he usually scoops up stocks when others are fearful, after all. What's more, he even ranked Alphabet behind at least 4 or 5 other businesses that Berkshire owns, saying he doesn't like it as well as some of his favorites. But when it comes down to it, his Alphabet buys are the deliberate application of the approach he's preached for 40 years. A wonderful company at a fair price beats a fair company at a wonderful price. He isn't buying when there's blood in the streets, but he's betting that when a business is this dominant and hard to replicate, the entry price becomes almost irrelevant over a 10-year horizon. Pay a little too much for a truly great business, and time bails you out. Buffett frequently talks about one of his favorite tests for a potential stock pick, focusing entirely on how long a business can maintain its dominance rather than its past success. And he clearly believes Alphabet will stay dominant for a very, very long time. He said it's more likely to be a winner than 95% of what Wall Street tries to sell you. So then, considering the stock just dropped after earnings despite everything just mentioned, which side is right? The bullseye, like Gene Mustar, argued the stock should have gone up, and the market wildly overreacted to the spending and underweighted the strongest cloud numbers in the company's history. The bears stress that depreciation from this enormous capex wave starts hitting the income statement hard in 2027, a cost the market hasn't fully priced in. There's also plenty of concern about a possible AI overbuild, where supply races past real demand and Alphabet is left with underutilized, depreciating data centers. We also now have Chinese competitors building comparable AI at a lower cost. And to be fair, Buffett, kind of remarkably, gave voice to these concerns. He pointed out that the hyperscalers are now laying out hundreds of billions of dollars, called it, quote, real money, and said they're playing a game they don't necessarily want to play, but can't afford to abandon. So Buffett bought the stock and in the same breath admitted the central risk that could sink it. That doesn't sound like a man who's lost his discipline and is just FOMOing in. He's weighed the risk and decided it's a good bet. He bought Alphabet when he finally understood its market position well enough to justify paying what it costs. Sometimes the smartest money in the room decides that quality is worth paying full price for because that quality is so rare. The mistakes ordinary investors often make is assuming every great investor is always looking to buy the bottom and sell the absolute top. But the legendary investor who spent 20 years calling Alphabet the one that got away didn't catch it on sale. Far from it. He bought near the top because he believes in the stock. But only time will tell if this is another Buffett banger or a big Buffett blunder. But what do you think? Is Buffett making a sensible investment here? Or is this 95-year-old finally chasing tech right at the top of the AI spending mania? Let us know your thoughts in the comments down below. And if you want to understand whether that AI spending frenzy is a revolution or a bubble waiting to burst, then you can watch our video on that right over here. And if you want to see why Berkshire's record cash pile might in fact be a warning about the rest of the market, then check out our video on that right over here. Thank you all very much for watching, and I'll see you in the next one. This is Nick, signing off.